All right, testing, testing, 1, 2, testing, testing. This is Terrell here. Hey, everyone watching this video. I'm going to introduce the first video here on life and health insurance in Georgia, and really wanted to just simply produce a lot of content. So, as a prompt, this video is shot on photo booth. Don't mind the background, don't mind the editing, and don't mind me slowly reading because it does get a little tiring and sleepy. So here it is. And if you have any questions, please feel free to leave it in the comments. All right. So let's start this course. I'm going to be recording myself doing the course for, of course, the benefit of others. And I also need to get this done as soon as possible. So I figure it would be a good idea to share and verbalize. And I'm going to be taking the Georgia Life and Health pre-licensing course. And get started with it right now. There's an introduction. Any videos, I'll just go ahead and mute just because who wants to listen to a video, right? Alright, thank you for choosing Excel. Below you will find useful information about your insurance course. The study materials for this course were created solely for you as you prepare to pass your state licensing exam. Each section is loaded with rich online content, including interactive assessments, engaging multimedia content, and customized learning paths. Our courses and test simulations are state and provider specific. We develop our e-learning courses based on the exam content outlines published by your state. Our subject matter experts review the outlines and provide the most up-to-date information that educates students utilizing our blended learning solution. Our goal is to prepare you to pass the first time. Please note you'll need versions of your web browser to the latest versions to properly run our courses. So I'm going to need to update my Chrome, which I will do. Your learning DNA. The way we learn has changed rapidly over the years. Advances in technology have both increased the volume of information available and accelerated the pace of education. Nearly 75% of all high school seniors currently take at least one online course, and e-learning is rapidly becoming a major component of instructional delivery in all major colleges and universities. Instructors now teach more in less time, while students are prepared to learn faster than ever before. Our robust preparing people to pass learning platform seamlessly unites a wide array of specific e-learning tools that range from ebooks, interactive learning objects, engaging videos, comprehensive assessments, mobile solutions, and more. Each tool is strategically positioned in a comprehensive online course management system designed to improve the online learning processes and proven to enhance student outcomes. Course development, we recognize that no two students are created equal, and each of us has a unique learning style as unique as our DNA. Thus, the instructional design of our learning objects and online courses focuses on the research-based practice. Everyone learns from a combination of 8 different learning styles. Have you ever tried to learn something fairly simple yet failed to grasp the key ideas? Have you tried to teach people and found that some of them were overwhelmed or confused by something quite basic? Yes. If so, you may have experienced a clash of learning styles. Your learning preferences and those of your instructor or audience may not have been aligned. When this course occurs, not only is it frustrating for everyone, but the communication process breaks down and learning fails. By understanding these 8 key learning styles, you can learn to create an environment in which everyone can learn from you, not just who use your preferred style. This is going to be key for me, because that's my biggest issue, not being able to teach someone who doesn't have the same learning styles as my usual audience. Like, I can adjust, but it needs to be adaptive to the person that I'm speaking with uniquely every single day, every single person, which is going to be the challenge. If so, you may have experienced a clash of learning styles. Your learning preferences. Alright, so yes. Each chapter is designed to blend several learning styles. Each chapter is designed to blend several types of learning styles. Reviewing each chapter in the following manner is essential in order to maximize your learning experience and fully take advantage of our blended learning platform. First, you play the chapter intro video that will introduce you to the key topics for each chapter. Review the chapter keywords that will be covered in the chapter. Once you've completed the reading passages, review the keywords and make sure to watch the chapter summary video. The subject matter expert will cover the key areas from each chapter. Feel free to pause, rewind, and make note of things that confuse you and watch again. Once you feel you have a solid understanding of the key topics, select your chapter exam. Then this exam requires a 70% pass score to move on to the next chapter. On average, it takes new students 3 attempts before achieving the minimum score. If you do not pass after your 3rd attempt, please go back into the chapter study materials and review the information. Here's some study tips. Once you get a 70% or greater, move on to the next chapter. Do not go back and retake the chapter quizzes after obtaining a 70%. Do not memorize the questions on the quizzes and practice exams. Do use Cliff Notes located in your resources to help you if needed, which I'll probably just write mine down. Be sure to make note of the topics which challenged you for review. After you've completed and passed all chapters, move on to the Prep Review course. The Prep Review course uses the same outline as your main course. However, the content, videos, and chapter exams are scaled down to only the information on your state exam. The chapters are weighted, questions and content exactly like the state exam, helping prioritize your studies based on the most important concepts. Also, the Prep Review raises the minimum score to pass 80% on all chapter exams. After completing the Prep Review course, move on to the exam simulators. Section 1 gives 200 exam practice questions. We call this section flashcards because you can pull it up on any mobile device and sneak a few questions in throughout the day. Section 2 incorporates the same amount of questions per section as the state exam. And Section 3 is going to use the same question count, including pre-test and experimental questions, the same weight by topic, and the same time requirements as your state exam. To make sure you are fully prepared to pass your state exam, all exam simulators require an 85% or better to move on. Alright, I'm going to go ahead and update. I'm going to relaunch and update, of course. So let's do that. Make sure my browser's up to date. Minutes so far. Let's see how long this takes us. I'm gonna need to get through this in 3-4 days. If not, I'll pay the extension. I just started, so it's not like I've been in the course, but I don't know why I only got a few weeks or whatever. A week now. Zoom. 1% done. All right. Here's a video Basic principles of life insurance and annuities. 4 lessons. Basic principles, introduction, summary, chapter exam. So video, minute long. So I'll just pause.
This section will introduce you to the basic principles of life and health insurance and annuities. You will learn about the role of insurance, get an industry
Well, no,
overview,
I guess I'll
learn about the different
give you
types
guys
of
the audio
insurance
if you
companies,
can hear it.
how insurance is sold, the history of insurance regulation, and who oversees the insurance industry. In this section, pay special attention to the following key topics: stock companies, mutual companies, Lloyd's of London, reinsurers, the 1945 McCarran-Ferguson Act, 1970 Fair Credit Reporting Act, the NAIC, which is the National Association of Insurance Commissioner, the State Guarantee Association, and the different rating services, which are AM Best, Standard & Poor's, Moody's, and Fitch.
That's it. That's it. Is there a next? Save and exit. Okay. Now let's get to the basic principles. Course just registered to me, TB. Accounts should be accessed only by the registered student. So yeah, you guys don't have access to my account, but definitely gonna have access to the knowledge here. All right, so let's see. I'm gonna do the notes on my phone and only on the stuff that seems to trouble me. Okay. Please review the following keywords as far as the basic principles of insurance. The understanding of their basic definition will improve comprehension of the content, chapter content. Actuarial department. The actuarial department calculates policy rates, reserves, and dividends. Okay, actuarial. Alien insurer. An alien insurer in the United States is an insurer whose principal office and domicile location is outside the United States, outside the country. Admitted insurer. An admitted or authorized insurer is an insurer who has received a certificate of authority from a state's Department of Insurance authorizing them to conduct insurance business in that state. A broker is a person. A broker represents themselves and the insured, the client or customer. Captive insurer. A captive insurer is an insurer established and owned by a parent firm for the purpose of insuring the parent firm's loss exposure. A captive insurer. Let's write that one down. Captive insurer. New note. Alright, so let's do this. Keywords. Oops. All right. Oh no, what's going on here? Different color. Excuse my handwriting. Actually. Captive insurer. A captive insurer is an issuer established and owned by a parent firm for the purpose of insuring the parent firm's loss exposure. Loss exposure mitigation. Insurance. Okay. Pause. All right. Certificate of authority. A certificate of authority is a license issued to an insurer by a department of insurance, equivalent to a state agency or equivalent, which authorizes that company to conduct insurance business in that particular state. Pretty cut and dry. Claims department. The claims department is responsible for processing, investigating, and paying claims. Divisible surplus. Divisible surplus is the amount of earnings paid to policy owners as dividends after the insurance company sets aside funds required to cover reserves, operating expenses, and general business purposes. Okay, same as stocks, basically. Domestic insurer. A domestic insurer is an insurer with its principal or home office in a state where it's authorized. Foreign insurer. A foreign insurer is an insurer with its principal office or domicile location in a state different than the state it's transacting insurance business. Fraternal benefit society. Fraternal benefit societies are non-profit benevolent organizations that provide insurance to its members. That's interesting. Industrial insurer. Industrial insurers make up a specialized branch of the industry, primarily providing policies with small face amounts with weekly premiums. Other names for industrial insurers include home service or debit insurers. Insurance, the transfer of risk through the pooling or accumulation of funds. Insured, the insured is the customer receiving insurance protection under an insurance policy. Insurer, the insurer is the insurance company, obviously. Lloyd's of London. Lloyd's of London is not an insurer, but a group of individuals and companies that underwrite unusual insurance. So they're an underwriting for unusual insurance, probably like Red Bull, Red Bull Sports. Multi-line insurer. A multi-line insurer is an insurance company or independent agent that provides a one-stop shop for businesses or individuals seeking coverage for all of their insurance needs. For example, many large insurers offer individual policies for automobile, homeowner, long-term care, life, and health insurance needs. Mutual insurance company. Mutual insurance companies are insurance companies characterized by having no capital stock, being owned by its policy owners, and usually issue participating insurance. Non-admitted insurer. A non-admitted or unauthorized insurer is an insurer who has not received a certificate of authority from a state's Department of Insurance authorizing them to conduct business in that state. Insurance business, of course. Non-participating policy. A non-participating insurance policy, typically issued by stock companies, do not allow policy owners to participate in dividends or elect or electing the board of directors. Participating plan. A participating plan is usually an insurance policy under which policy owners share in the company's earnings through a receipt of dividends and also elect the company's board of directors. Private or commercial insurer, a private or commercial insurance company. Private or commercial insurance companies are companies owned by private citizens or groups that offer one or more insurance lines. Commercial insurers are not government owned. Reciprocal insurer. A reciprocal insurer is an unincorporated organization in which all members insure one another. Reinsurance. Reinsurance is the acceptance by one or more insurers, called reinsurers, of a portion of the risk underwritten by another insurer who has contracted for the entire coverage. So essentially, the insurer needs help, or just wants to assign risk. Yeah, they need help with that risk. So the reinsurer is a reinsurer. A reinsurer is a company that provides financial protection to insurance companies. Reinsurers handle risks that are too large for insurance companies to handle on their own and make it possible for insurers to obtain more business than they would otherwise be able to. Exactly. Risk retention group. A risk retention group is a group-owned liability insurer which assumes and spread product liability and other forms of commercial liability risk amongst its members. It's pretty cool. Self-insurers. A self-insurer establishes a self-funded plan to cover potential losses instead of transferring the risk to an insurance company. Stock insurance companies. A stock company is an insurance company owned and controlled by a group of stockholders or shareholders whose investment in the company provides the safety margin necessary in the issuance of guaranteed fixed premium non-participating policies. So they use the premium to prop up the company and then have that safety margin. Surplus lines insurance. Surplus lines insurance is non-traditional insurance only available from a surplus lines insurer. They offer coverage for substandard or unusual risks not available through private or commercial carriers. And an underwriting department. The underwriting department is the department within an insurance company responsible for reviewing applications, approving or declining applications, and assigning risk classifications. So we got through all of those lines, and here we are in chapter 1, intro. Got through all those words. This chapter offers an overview of the insurance industry. It introduces basic principles, how insurance is sold, and the common types of insurance companies along with their important functional departments. The chapter also looks at some regulatory principles and industry organizations that help govern the insurance industry across state lines. It provides a framework for studying your state-specific definitions, regulations, rules, and obligations, which we will thoroughly discuss in the state-specific chapter located at the end of this course. Some state exams test general principles in state law separately. Other states combine them into one exam. If your test integrates state law and general principles, please remember that state law supersedes the general content in the event of a conflict. Okay. The content in this chapter is broken into the following sections: the role of insurance, the types of insurance companies, the departments within an insurance company, key people within an insurance company, how insurance is sold, evolution of industry oversight. Review of this chapter will enable one to better understand the broad purpose of insurance and its benefits to society, understand how insurance is sold, describe the difference between private and government insurance, differentiate between mutual and stock insurance companies, differentiate between participating and non-participating policies, comprehend the basis for the industry's state-based regulatory system, understand the various departments within an industry company and their role, differentiate between career agency systems, personal producing general agency systems, and independent agency systems, understand the methods of selling insurance without a licensed agent, differentiate between domestic and foreign and alien insurance companies, understand the role rating services play within the insurance industry. Okay. I'm surprised there's no audio for ADAs. The role of insurance. I'm providing the audio for anybody who has that disability of reading, you know. And then my video will also have captions. How about that? The role of insurance. For more than a century, insurance has been recognized as an essential element in an individual's or family's financial planning program. Insurance helps to reduce the financial uncertainty of the policy owner with regard to possible future losses. A financial planning program should include the individual or family's general and specific financial goals and a plan to achieve those objectives. This chapter will review the basic principles, nature, and legal concepts of insurance contracts. And not to provide too much commentary here because I have to really get through this course, but that is really important. People need to understand that this is a financial planning program, you know, as far as your insurance goes. Like, it's not a matter of investing per se. It's not a replacement for investment, and it's really not a get rich thing. It's for the curbing of your loss in the future, you know, mitigating future losses, assigning the risk to a large company. That's really, in my opinion, how capitalism works. Because if not, your costs go up and income doesn't, based on the amount of inflation compared to the increase of your income. So in America, if you don't have something that results in risk mitigation, something is going to happen based off of the law of averages. So that's why insurance is super important, and I feel very impassioned about it, because it would change a lot of systems of inequity, a lot of situations of inequity or complete loss for my community in particular. And when that happens, when my community in particular is more equal or able to show a more equal standing in our American society, the ideological shift will happen, and we will not be hindered by basic ridiculous bias within a system that holds people back, that reduces the diversity of ideas in simple growth. You know, your growth is exponential when you include all possibilities, as opposed to past precedental, successive standard. Like you're establishing a standard of success in the past, and using the things that have been successful for you, but you don't have the exponential growth that you would see if you used all of the ideas available. So that's why I think insurance is very important. And we'll get back to the course here. The concept of insurance, in generic terms, may be defined as the transfer of risk from one party to another through a legal contract. Insurance can be defined as the transfer of risk through pooling or accumulation of funds. When a person purchases insurance, that person, identified as the policy owner or applicant in insurance transactions, transfers the possibility of suffering a large financial loss to an insurer in return for paying a relatively small contractually defined premium. Insurance spreads the risk of loss from one person to a large number of persons through the pooling of premiums. When the transfer of the risk is accomplished by purchasing an insurance policy, the policy owner obtains a large quantity of coverage in return for a small fee, which is the premium. So, a lot of people are very skeptical of insurance contracts, but, those same people are simply aware of what a contract is. So, as long as you read your contracts and abide by them, both parties are held liable at all times. This is one of the only things in America that people agree on. Benefits and costs of insurance to society. Insurance evolved as a practical solution to economic uncertainties and losses. Most insurance contracts including health insurance and property and casualty policies, pay off financial losses and reimburse the insured. They indemnify policyholders, which means the policies restore insureds to the financial position they enjoyed before the insured loss. Eliminating the possibility of an unplanned expense is arguably the most significant advantage of an insurance contract. Insurance also lessens the chance of a person suffering loss will have to pay entirely for a loss out of their own funds, thus allowing for the benefit of greater management of cash flow and providing for better loss control. That's key. Death may strike anyone prematurely, as we know. When death takes a family provider, aka the breadwinner, surviving family members suffer if they are left without adequate income. Life insurance pays death benefits and creates an instant estate, regardless of when the death occurs. On the other hand, when people face the unpleasant prospect of outliving their income, annuities can generate a lifetime income stream to help solve or alleviate this problem. So both annuities and having insurance can, you can easily see how it can affect a person's life and family after their life. Mainly that, but also their own life. Types of insurance companies. There are many ways to classify insurance that provide insurance. Conventional methods of insurer classification include where the company is located, how the company is owned, and if the company is authorized in a given state. In the broadest of terms, insurance companies are typically classified as private or commercial and government. Within these private, commercial, two of the same, and government. Within these two classes are many categories of insurance providers, as well as insurance plans and insurance producers. It is important to note that the company providing the insurance is called the insurer. The covered person is known as the insured. Continuing into types of insurance companies. Private, (commercial) insurance companies. Commercial insurers are private companies offering many lines of insurance. Some only sell life insurance and annuities, while others sell only accident and health insurance. I'm not sure if I'm too close to the mic or too far away, so we're going to just try both. All right. Some only sell life insurance and annuities, while others sell only accident and health insurance or strictly property and casualty insurance. Companies that sell more than one line of insurance are known as multi-line insurers. A company that sells one line of insurance is a monoline insurer. Stock and mutual companies can both be considered commercial insurers, and as such can write life, health, property, and casualty insurance. Stock companies, non-participating. A stock company is a private organization organized and incorporated under state laws for the purpose of making a profit for its stockholders or shareholders. It is structured the same way as any corporation. Stockholders may or may not be policyholders. When declared, stock dividends are paid to stockholders. In a stock company, the directors and officers are responsible to the stockholders. Stock insurance companies issue non-participating insurance policies. Non-participating insurance policies do not allow policyholders to participate in the company's profits or to receive dividends. As opposed to passing on savings to policyholders, stock companies look to grow their earned surplus or post-tax earnings not paid in dividends. Earnings retained by a company are considered equity and as such are owned by the shareholders. Non-participating insurance policies also do not allow policyholders to participate in electing the company's board of directors. So from my interpretation, it sounds like stock companies, non-participating, are companies that don't pass on the dividends to policyholders, they pass it on to their shareholders. So the shareholders don't have to be policyholders, but the earned surplus from the non-paid dividends goes back into the stock company as post-tax earnings, essentially, the cash equity, and that is also owned by the shareholders. So, pretty interesting there, way of doing it. Mutual companies participating. Mutual insurance companies are also organized and incorporated under state laws, but they have no stockholders. Instead, the owners are the policyholders. Anyone purchasing insurance from a mutual insurer is both a customer and an owner. He has the right to vote for members of the board of directors. He or she, right? Mutual companies are referred to as participating companies because the policyholders participate in dividends. By issuing participating policies that pay policy dividends, mutual insurers allow policy owners to share in any company earnings, the divisible surplus. The divisible surplus is the amount of earnings paid to policyholders as dividends after the insurance company sets aside funds required to cover reserves, operating expenses, and general business purposes. Essentially, policy dividends represent a refund of the portion of premium remaining after the company has set aside the necessary reserves and has made deductions for claims and expenses. Policy dividends can also include a share in the company's investment, mortality, and operating profits. Surpluses are typically distributed to policy owners on an annual basis. Occasionally, a stock company may be converted into a mutual company through a process called mutualization. That's pretty cool. Likewise, the mutual companies can convert to stock companies through a process called demutualization. In the rare case of a stock insurance company issuing both participating and non-participating policies, the company is referred to as using a mixed plan. Now, and if you guys hear that beep, that's the clients coming into our team Zoom, but please try to ignore them, ignore the beeps. Once again, this is really a rough video or recording to just get the information online and out there to hopefully build my audience in Georgia. because I'd absolutely want to write as many people as possible. So once I get done with this, all of the information for contacting me will be made. All that stuff will be included in each video. All right. So in red here at the bottom of this chapter, we have participating policies allow policyholders to participate in the company by electing the board of directors and receiving dividends from the divisible surplus. Non-participating policies do not, that should be a do not. It says policies to not, but it should be a do not, allow to policyholders to participate. I think there's some typos here. Non-participating policies do not allow policyholders to participate in elections or dividends and instead aim to increase profit for shareholders. So if you were to be reading that, it would look crazy because it says policies to not allow to policyholders to participate. So they need to revise that. All right, types of insurance companies. Strong assessment mutual insurers. Assessment mutual companies are classified by the way in which they charge premiums. A pure assessment mutual company operates on the basis of loss sharing by group members. No premium is payable in advance. Instead, each member is assessed a portion of the losses that occur. An advance premium assessment mutual charges a premium at the beginning of the policy period. If the original premiums exceed the operating expenses and losses, the surplus is returned to the policyholders as dividends. However, if that's my son. Son. He's like watching something. Can you please be quiet, please, a little bit? He said no. Anyways. However, I guess I'll just read the sentence again. If the original premiums exceed the operating expenses and losses, the surplus is returned to the policyholders as dividends. However, if total premiums are not enough to meet losses, additional assessments are levied against the members. Typically, the amount of assessment that may be levied is limited either by state law or simply as a provision in the insurer's bylaws. Okay? So, with the mutual insurers, you're essentially hoping that the company is doing good business and you're able to premium is payable in advance. Each member is assessed a portion of losses that occur. So they're just covered until they need to do the loss. Then they have to pay the loss. Risk retention and risk purchasing groups. This is something I'm kind of interested in. A risk retention group is a mutual insurance company formed to insure people in the same business, occupation, or profession, e.g. pharmacists, dentists, or engineers. These group-owned liability insurers assume and spread product liability and other forms of commercial liability risk among its members. This type of group is formed for the primary purpose of retaining or pooling risks. Risk retention groups are licensed in their state of domicile and are owned by their policyholders, who are business owners, who are also the shareholders. Once these groups are organized, they can offer membership to others who possess similar risks. A risk retention group or risk purchasing group only has to be licensed in one state but may insure members in any state. So it's obviously a group of doctors, lawyers, or something that would entitle the same risks of business, of opening a business, operating risk, those types of things. Very, very interesting. Reciprocal insurers. Similar to mutual insurers, reciprocal insurers are organized on the basis of ownership by their policyholders. However, with reciprocal insurers, it is the policyholders themselves who insure the other policyholders' risks. Each policyholder assumes a share of the risks brought to the company by others, and an attorney in fact manages reciprocal insurers. So they have to have an attorney in fact because everybody is bringing in their own risk. And then people are able to reciprocate in buying each other's risk. Or insuring each other's risk, right? Reinsurers and retention limits. Reinsurers are a specialized branch of the insurance industry because they insure insurers. Reinsurance is an arrangement by which an insurance company transfers a portion of an assumed risk to another insurer. Usually, reinsurance occurs to limit the loss any one insurer would face should a very large claim become payable. Another reason for reinsurance is to enable a company to meet specific objectives, such as a favorable underwriting or mortality results. The company transferring the risk is called the ceding company, the company CEDING. The company assuming the risk is the reinsurer. The portion of the risk that the ceding insurer retains is called the net retention or net line. So I'm going to read that one more time to better understand it myself. The portion of the risk that the ceding insurer retains is called the net retention or net line. A typical insurer, so that would be the ceding company. The risk that they keep is going to be called, I'm getting a call here. I'm going to have to call them back. Yeah, I'll call them right back. The portion of the risk that the ceding insurer retains is called the net retention or net line. A typical reinsurance contract between two insurance companies is called a treaty, and reinsurance is called treaty reinsurance, which involves an automatic sharing of the risk assumed. In a reinsurance agreement, the insurance company that transfers its loss exposure to another insurer is called the primary insurer. So the ceding company the ceding company is also the primary insurer in the reinsurance agreement. I gotta definitely probably understand that really deeply, even though I probably won't come across it that much. Service providers. Service providers sell medical and hospital care services to their subscribers, not insurance, in return for a premium payment. Benefits are in the form of services provided by the hospitals and physicians participating in the plan. They sell medical and hospital care services, not insurance. These services are packaged into several different plans, and those who purchase these plans are known as subscribers. Another type of service provider is a health maintenance organization, HMO. HMOs offer a wide range of healthcare services to member subscribers. For a fixed periodic premium paid in advance of any treatment, subscribers are entitled to the services of specific physicians and hospitals contracted to work with the HMO. Unlike commercial insurers, HMOs provide financing for healthcare plus the healthcare itself. HMOs are known for stressing preventative healthcare and early treatment programs. So most people know about the HMOs via HSAs and FSA healthcare plans from their job. Another person calling me. Yeah, okay. Where am I at? The third type of service provider is the Preferred Provider Organization, or PPO, which I believe that HSA uses PPOs in. Or no, PPOs are your basic national or your major healthcare plan, and then HSA and FSA are going to be the HMOs, where you put in a little bit of money towards it, and it helps you get the service done. And that one has participating providers, and the PPO is also a participating provider plan, but it's usually pretty large. The third type of service provider is a preferred provider organization. Under the usual PPO arrangement, a group desiring healthcare services, i.e. an employer or a union, will obtain price discounts or special services from certain select healthcare providers in exchange for referring its employees or members to them. PPOs can be organized by employers or by the healthcare providers themselves. The kind of services provided is spelled out in the contract between the employer and the healthcare professional. Insurance companies can also contract with PPOs to offer services to the insured, which very, very helpful, in my opinion. Fraternal benefit societies. Insurance is also issued by fraternal benefit societies, which have existed in the United States for more than a century. Fraternal societies, noted primarily for their social, charitable, and benevolent activities, have memberships based on religious, national, or ethnic lines. Fat shirt. All right, and Fraternal First began offering insurance to meet their low-income members' needs, funding the benefits on a pure assessment basis. Today, few fraternals rely on an assessment system. Most have adopted the same advanced funding approach other insurers use. To be characterized as a fraternal benefit society, the organization must be nonprofit, have a large system that includes ritualistic work, and maintain a representative form of government with elected officers. Fraternal must be formed for reasons other than obtaining insurance. Today, most fraternal benefit societies issue group insurance and annuities with many of the same provisions found in commercial insurers' policies. Fraternal benefit societies are more concerned about maintaining minimum reserves and surpluses for coverage than providing dividends or profits. Lloyd's of London. Contrary to popular belief, Lloyd's of London is not an insurer, but rather a syndicate of individuals and companies that individually underwrite insurance. Lloyd's can be compared to the New York Stock Exchange, which provides the arena and facilities for buying and selling public stock. Lloyd's function is to gather and disseminate underwriting information, help its associates settle claims and disputes, and through its member underwriters provide coverages that might otherwise be unavailable in certain areas. Self-insurers, through self-insurance, though self-insurance is not a method of transferring risk, it is an important concept to understand. Rather than transfer risk to an insurance company, a self-insurer establishes a self-funded plan to cover potential losses. Large companies often use self-insurance for funding pension plans and some health insurance plans. A self-insurer will often look to an insurance company to provide insurance above a specified maximum loss level. the self-insurer will bear the amount of loss below that maximum amount. Continuing on. Captive insurer. An insurer established and owned by a parent firm for the purpose of insuring the parent firm's loss exposure is known as a captive insurer. Surplus lines insurance. Surplus lines insurance is available to those who need protection, but is not available through private or commercial carriers. Surplus lines insurance refers to the non-traditional insurance market. A person will seek coverage through a surplus lines broker in order to secure coverage for high, substandard, or unusual risks, i.e. hole-in-one insurance or non-appearance coverage. In order to qualify for surplus lines insurance, surplus lines coverage, an effort has to be made to secure coverage in the authorized market. An individual may not attempt to secure coverage just because it may be less expensive. Insurance is sold through an industrial insurer. Insurance is sold through a specialized branch of the industry known as home service or debit insurers. These companies specialize in a particular type of insurance called industrial insurance. Industrial insurance is characterized by relatively small face amounts, usually 1 or 2 thousands, with premiums paid weekly. Industrial insurance is characterized by relatively small amounts, usually $1,000 or $2, with premiums paid weekly. Private versus government as insurer. Private citizens or groups own private or commercial insurance companies. They may be proprietary or cooperative. An example of a proprietary insurance would be a profit-motivated stock company. Private insurance offer individual, group, or industrial or blanket insurance policies. Federal and state governments are also insurers. Insurance provided by federal and state governments is commonly called a social insurance program. Social insurance programs range from crop insurance to bank and a savings and loan deposit insurance. Government insurers are owned and operated by a federal or state entity. Government insurers may either write insurance to cover perils that are not insurable by commercial insurers, war, flood, or nuclear reaction, or write insurance on risks that are insurable and thus compete with the commercial marketplace, such as workmen's compensation. Government insurers usually write insurance to cover catastrophic perils like floods, or to protect a segment of society like the elderly against catastrophic medical costs like Medicare. So these programs have far-reaching effects with millions of people relying on these plans. Additional examples of social insurance programs include old age survivors and disability insurance, commonly known as Social Security, which they're trying to do away with, just to kind of put that into context of today's day and age. Social Security is absolutely one of the social safety net programs that the conservative class of politicians want to do away with, like they think it is too expensive for us to pay for. Social Security hospital insurance and supplemental medical insurance, commonly known as Medicare, and Medicaid is also low-income health insurance. Servicemen's Group Life Insurance, SGLIs and VGLIs, Veterans Group Life Insurance, National Flood Insurance Program, and the Federal Crop Insurance Cooperation. As you can see, the government plays a vital role in providing social insurance programs. These programs These programs pay billions of dollars in benefits every year and affect millions of people. So I'm of the political ideology or thinking that we should probably bolster or invest in these types of programs, at least not do away with them. All right. Insurer classification according to authorization. An insurer that is admitted or authorized to transact insurance business in a particular state is related is referred to as an authorized insurer in that state. Also known as admitted insurers, an authorized company is issued a certificate of authority. Generally, an unauthorized or non-admitted insurance company is not permitted or nor allowed to conduct insurance operations in a particular state. In some cases, a non-admitted insurer may still offer surplus lines of insurance without a certificate of authority if no authorized insurer in the market is available or willing to take the risk. The surplus insurance market is heavily regulated, requires additional licensing, and typically does not offer the consumer the same protections as the primary insurance market. Insurer classification according to domicile. A domestic insurer has its principal or home office in the state where it's authorized. In other words, an insurance company is authorized. An insurance company authorized, admitted to. Wait, 1 second. Okay, give me 1 second. Authorized, admitted to transact insurance business in the state where it is chartered or incorporated, is classified as a domestic insurer only in that state. A foreign insurer is authorized in one state but is charter or principal office in another state. An alien insurer is an insurer authorized in any state within the United States but his principal office is outside the country. For example, Nationwide Insurance Company of Columbus, Ohio, operates as a domestic insurer in the state of Ohio. Nationwide Insurance Company is also licensed and authorized in the state of Illinois. Therefore, it operates throughout the state of Illinois as a foreign insurer. Nippon Life of Tokyo, Japan, or Sun Financial Services of Toronto, Canada are examples of alien insurers. All right, so we've been going at this for about how long? Let's see what our time is looking like. An hour. All right, we'll take a quick break. Blade, my cub, my little youngin, asked me for something. Let's see what he wants. All right, so as you can see, that is pretty straightforward. It's just, of course, me reading off of it. And what I want to do is definitely share more of that. So I'll try to edit as much as I can, but I don't have time for that. As you can also see, I'm a single parent. So from here on out, I'll be definitely posting a lot of resourceful information and going over as much as I can and learn as I learn it with you guys. So strap in, and definitely appreciate any of the views and comments and likes. Please subscribe, all of those things. Appreciate it. Signing off.